Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Ralph Lauren stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 8 billion market cap. They're trading at $123 a share and they have 65 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow every year. $500 million in 2020. It got cut in half to $270 million in 2021. Then it doubled to $549 million in 2022. And then down to $194 million in 2023. They did complete their 2023 fiscal year because their fiscal year ends 3/31. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was $380 million in 2020, negative in 2021 due to lower revenue. They had the highest at 2022 at $600 million. It came down a little to $520 million in 2023. Revenue is a sales for the company, and that was over $6 billion in 2020, dropping to $4.4 billion in 2021, mainly due to COVID and lower sales. Their 2021 fiscal year is from April 1st, 2020 to 3/31/2021. Then 2022 was a little higher than 2020, so they did rebound, higher in 2023 to $6.4 billion. Let's look at their capital structure. $2.4 billion of equity, $2.9 billion of debt. They're 46% equity, 54% debt. Their net debt is $1.3 billion. So that means they have about $1.6 billion of cash on their balance sheet. I gave them a whack of 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $10 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8.8 billion. We divide that by 65 million shares. And we get a calculated stock price of $135. They're trading at $123, so they're trading at an 8% discount. It's a buy according to the model. They do pay a quarterly dividend. It was 50 cents in 2017, up to 75 cents currently. That's a yield of about 2.5%, which is 101% of their free cash flow, 38% of their net income. Let's take a look at this stock on Simply Wall Street. Ralph Lauren designs, markets, and distributes lifestyle products in North America, Europe, Asia, and internationally. Simply Wall Street's valuation is $141. They say the stock is 12.5% undervalued. 16 analysts priced this stock and the average price target is $132. They say the stock is 7% undervalued. Here's their trailing 12-month revenue since 2012. It was $7 billion back then. It looks like it peaked at about $7.6 billion in 2015. At the height of COVID, it was a little over $4 billion. It has rebounded. It's up to $6.5 billion. But their revenue is about 10% lower than 2015-2016 levels. Here's their dividend yield since 2012. It was 1% in 2012. It looks like they cut their dividend in 2020 due to COVID. They did bring it back. It was over 3% in 2022. That's its highest level in a while. And the forecast is for the yield to be 3.1% by 2026. 64% of the company is held by institutions, 28% by insiders, and 8% by private companies. The biggest shareholder is Ralph Lauren at 30%. His stake is $2.4 billion. Then the Lauren family, BlackRock, Vanguard, and T. Rowe Price. Their employee count in 2013 was 18,500. It's been pretty steady since then, currently at 19,000. The stock trades on the New York Stock Exchange, Xetra, Börse München, Deutsche Börse, London Stock Exchange, Mexican Bolsa, and Sao Paulo Bolsa. Let's look at this stock in Yahoo Finance. It trades at 123, 8.1 billion market cap. The 52-week range is 82 to 129. About 1 million shares are traded each day. A beta of 1.39, PE of 16, and dividend of 2.5%. Yahoo's 1-year price target is 131, so they say the stock is undervalued. It looks like the stock started trading in 1998. They started paying a dividend in 2003. It did break through $100 in 2007. It came down to about 25 in 2009, probably due to the Great Recession. Then it had a really big bull run, getting close to $200 by 2015. That looks like its highest point. It did come down to below 75 in 2017. Then it hit 150 in 2018. Then it dropped to about 65 at its COVID lows. It broke through 130 in the first quarter of 2021. Then it dropped to 85 at the end of 2022. But throughout 2023, it's pretty much been trading above $100. Last year, its market cap was $8 billion, where it's currently at. It bottomed out at $5.8 billion in the third quarter of 2022. The stock is up 34% in the past 52 weeks, while the S&P is up 17%. Most of the shares outstanding are on float and has a really high short percentage. 27% of the shares on float are shorted. Here's their 10K for fiscal year ended 4/1/2023. Let's look at their income statement. For 2021, revenue of $4.4 billion, jumping to $6.2 billion in 2022. 2023, it's $6.4 billion. Let's see if we get more info on what the $6.4 billion represents. Of the $6.4 billion, $4 billion is retail, $2.2 billion is wholesale, and $157 million in licensing. $3 billion of their revenues in North America, $1.8 billion in Europe, $1.4 billion in Asia. The cost of goods sold, the cost to buy the products and materials and to make everything, is $2.3 billion. Gross profit of $4.2 billion. Pretty similar to last year, a lot higher than 2021 because revenue is about 50% higher. Selling, general, and administrative expenses, $3.4 billion. That includes payroll, marketing. So their operating income is $704 million, down from last year of $800 million, but up from 2 years ago, which was negative $44 million. They spent $40 million of interest on their debt, $32 million of interest income. So their net income is $523 million, down from last year of $600 million. Earnings per share of $7.72. The next stock we're going to look at in apparel manufacturing is VF Corp. Let's get started with the model. This is a mid-cap company, $7.6 billion market cap. They're trading at $19.51 a share, and they have 390 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doubled from 2020 to 2021, over $1 billion. Then it was cut in half to $536 million. Then they had a really big negative in 2023, negative $900 million. Net income is a profit or loss on the income statement. It's revenue minus expenses. And that doubled from 2020 to 2022, but it's only $119 million in 2023. Revenue is a sales for the company, and that of course drops from 2020 to 2021. They had their highest revenue in 2022, close to $12 billion. It declined a little bit to $11.6 billion in 2023. Let's look at the capital structure. $2.9 billion of equity, $7.8 billion of debt. They're 27% equity, 73% debt. Their net debt is $7 billion, so they have about $800 million of cash on their balance sheet. They have a pretty high WACC, 13.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $12 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $11 billion. We divide that by 390 million shares. And we get a calculated stock price of $28. They're trading at $19, so they're trading at a 31% discount. It's a strong buy according to the model. They were paying a 51-cent dividend last year, but they cut it to 30 cents recently. But it's still a really high yield, 6.15%, which is almost 4 times their net income. Let's take a look at this stock on Simply Wall Street. VF Corporation engages in the design, procurement, marketing, and distribution of branded lifestyle apparel, footwear, and related products for men, women, and children in the Americas, Europe, and Asia Pacific. Simply Wall Street's valuation is $16. They say the stock is 19% overvalued. 20 analysts priced this stock, and the average price target is 26. They say the stock is 35% undervalued. Their trailing 12-month revenue in 2012 was $10.4 billion. It did drop to $8.4 billion in 2017. In 2018, it came right back up to $12 billion. But right now, it's $11.6 billion. Not much growth. Their dividend yield in 2012 was 1.9%. It was fairly flat for the next 9-10 years. It hit 2.7% in 2021. And the yield has really gone up a lot because the stock price has been coming down. And they project the yield to break through 9% this year. And the projection for 2026 is 7.2%. It's a pretty good yield. In the past 12 months, there's been lots of insider buying, no selling, so that's a good sign. Last year, a couple of insiders were buying in the 40s, and now it's below 20, so it's a great deal if you were willing to pay over $40 for it. 83% of the company is held by institutions, 16% by the general public, and 0.7% by insiders. Vanguard is the biggest shareholder at over 10%, then PNC and BlackRock. They did have 57,000 employees in 2012. It was 75,000 in 2019, but it's come down a lot to 26,000 currently. This company trades on the New York Stock Exchange, Deutsche Börse, Xetra, London Stock Exchange, EuroTLX, Vienna, Mexican Bolsa, Bulgaria, and Sao Paulo Bolsa. Let's look at this stock on Yahoo Finance, trading at 1951, 7.6 billion market cap. The 52-week range is pretty wide, 17 to 49. Lots of trading volume, beta of 1.5, PE of 63, and a yield of 6.15%. The 1-year price target is 25. It looks like they started trading in 1980, and they were doing well in the beginning. They did a 2-for-1 split in 82, and then another 2-for-1 in 83. They started paying a dividend in the 80s. And by the late 90s, the stock was doing pretty well, breaking through $12. They did another stock split in 2013, a 4-for-1. The stock kept rising to over $100 in 2019. But it's down a lot. It's down about 80% since that peak. Look at their market cap last year, $22 billion. The following quarter dropped to $17 billion, then dropped to $12 billion. 11 billion, 9 billion, now it's at 7.5 billion. The stock just keeps coming down. And the stock is down 58% in the past 52 weeks, while the S&P 500 is up 17% in the same time frame. 7 million shares are traded each day. Most of the shares outstanding are on float. 82% are held by institutions, and 7.25% of the shares are shorted. Here's the company's 10K for fiscal year end 4/1/2023. Let's take a look at their income statement. This is 2021, 2022, and 2023. Revenue from 2021 was low, $9.2 billion. Their 2021 fiscal year is for 4/1/2020 through 3/31/2021. So it includes the worst months of COVID. It did come up to $11.8 billion in 2022. Now it's $11.6 billion. Let's see if we can get some more info on this $11.6 billion. Of the $11.6 billion, $6 billion from wholesale, $5 billion from retail, and $75 million from royalties. $6.7 billion of their revenue is in the Americas, $3.4 billion in Europe, $1.5 billion in Asia Pacific. And of the $11.6 billion, $5.6 billion is outdoor revenue, $5 billion of active revenue, and $1 billion of work revenue. Outdoor refers to outdoor apparel, footwear, and equipment. And these are the brands for outdoor: North Face, Timberland. I'm sure you're familiar with some of them. Active is active apparel, footwear, and accessories. Vans, Supreme, Eastpak. Their work segment is work and work-inspired lifestyle apparel and footwear. Dickies and Timberland Pro. Let's go back to the income statement. Below revenue is cost of goods sold, $5.5 billion. SG&A, $5 billion. Impairments of goodwill and intangibles, $735 million. So operating expenses of $11.2 billion. Operating income of $300 million, a lot lower than prior years. $174 million of interest on their debt. So their net income is only $118 million, down a lot from last year of $1.4 billion. EPS of 31 cents. Last year was $3.12. That's why the stock is coming down so much. They do have less shares outstanding. Last year was 390 million. Now they have 388 million. The next apparel company we're going to look at is Levi Strauss. Let's get started with the model. This is a mid-cap company, $6 billion market cap. They're trading at $15 a share, and they have 398 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had 339 million of free cash flow in 2020. It jumped to 570 million in 2021, but it's been negative after that. It looks like they're putting a lot back into CapEx since they have positive net income. Net income is the profit or loss on the income statement. It's revenue minus expenses. Negative in 2020, and it's pretty steady after that, around $500 to $570 million. Revenue is a sales for the company, and that goes up each year. $4.5 billion, then 5.8, 6.2, and 6.3 in a trailing 12 months. Let's look at the capital structure. $2 billion of equity, $2.2 billion of debt. They have 47% equity, 53% debt. Their net debt is $1.9 billion. That means they have around $300 million of cash on their balance sheet. I gave them a WACC of 10.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $7.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $7 billion. We divide that by 400 million shares. And we get a calculated stock price of $17.53. They're trading at $15, so they're trading at a 14% discount. It's a buy according to the model. They pay a quarterly dividend. It's 12 cents a share, a yield of 3.2%, which is 39% of their net income. Let's look at the company on Simply Wall Street. Levi Strauss engages in the design, marketing, and sale of apparels and related accessories for men, women, and children in the Americas, Europe, and Asia. Simply Wall Street's value is $19. They say the stock is 22% undervalued. 13 analysts priced this stock, and the average price target is $20. They say it's 29% undervalued. In 2012, their trailing 12-month revenue was $4.7 billion. It was pretty steady for a few years, growing to $5.8 billion in 2020. Then COVID hit. It got down to $4.3 billion. But after COVID, its revenue is higher than ever, breaking through $6 billion in the trailing 12 months. Dividend of 2.4% in 2020, then they cut it to 0. They brought it back in 2021, and the yield has been going up because the stock price has been coming down. The forecast is for the yield to be 3.8% by 2025. There doesn't seem to be insider buying. There was one sell in the past year, a few months ago, 5,000 shares. 57% of the company is held by insiders, 28% by institutions, and 15% by the general public. The Haas family owns a lot of this stock. Levi Strauss was the founder of this company. His second wife had the last name Haas. Peter Haas is the great-grandnephew of Levi Strauss. He died, but his wife is Miriam Haas, who's still living, and she owns 11% of the company, along with many people in the Haas family. That's why most of the company is held by insiders. Their employee count was 17,000 in 2012. It's currently 18,000. The ticker trades on the New York Stock Exchange, Deutsche Börse, Wiener Börse, Mexican Bolsa, and Euro TLX. Here's their latest 10Q for the period ending 2/26/2023. Let's look at their income statement. For the most recent quarter, revenue of $1.7 billion. Of the $1.7 billion, $1 billion is wholesale, $700 million is direct to customer. And about half their revenues in the Americas, $455 million in Europe, and $300 million in Asia. Their cost of goods sold is $750 million, gross profit of $940 million, SG&A $780 million, operating income of $157 million. That's down a lot from last year, probably due to inflation and higher expenses. They spent $10.7 million of interest on their debt, which is a lot higher than last year. Net income of $115 million, EPS of 29 cents, a lot lower than last year of 49 cents. And they have less shares outstanding this year, 396 million. Last year was 399 million. Let's look at them on Yahoo Finance. They're trading at $15.07, $6 billion market cap. The 52-week range is $13 to $20. Beta of 1.17, PE of 12, EPS of 122. dividend yield of 3.2%, and the 1-year price target is $18.55. Levi was publicly traded in 1971, but about 14 years later they were taken private. It looks like they went public again in 2019, and the stock started out at $22, then it fell under $10 when COVID hit. It ran up past 30, but it's down about 50% since that peak. You can see their market cap is down. It was $7.2 billion in May 2022, then 6.7, 6.5, 7 billion. Now it's down to 6 billion. The stock is down 10% in the past 52 weeks, while the S&P is up 17%. 2 to 2.5 million shares are traded each day. Of the 99 million shares outstanding, 89 million are on float, 82% are held by institutions, and over 11% of the shares are shorted. The fourth company we're going to look at is PVH. Let's get started with the model. This is a mid-cap company, 5.3 billion market cap. They're trading at $84 a share, and they have 63 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grew a lot from 470 million to 800 million, but then in 2023 it dropped to negative. It's still negative in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. They had a big negative that year due to COVID, lower revenue. It got up to 950 million in 2022, dropping to 200 million in 2023, and it's 203 million in the trailing 12 months. They completed their 2023 fiscal year, because their fiscal year ends 1/31. They've already completed 1 quarter of their 2024 fiscal year. Their 2024 fiscal year starts February 1st, 2023 and ends January 31st, 2024. Revenue is a sales for the company, and that was down to 7 billion from COVID. It jumped right back up there to 9.2 billion in 2022. Then it's been flat after that, around 9 billion. Let's look at the capital structure. 5 billion of equity, 3.8 billion of debt. They're 58% equity, 42% debt. Their net debt is 3.4 billion, so they have about 300 million of cash on their balance sheet. I gave them a WACC of 12.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.6 billion. We divide that by 63 million shares. And we get a calculated stock price of $89. They're trading at $84, so they're trading at a 5% discount. It's a buy according to the model. They pay a really tiny dividend, like Nvidia. They pay 4 cents a share, which is a yield of 0.18%. Let's look at the stock on Simply Wall Street. PVH operates an apparel company in the US and internationally. Simply Wall Street values the company at 134. They say the stock is 37% undervalued. 16 analysts priced this stock, and the average price target is 99. They say the stock is 18% undervalued. Their dividend yield in 2012 was 0.2%. For the next 8 years, it was either 0.1% or 0.2%. They cut it in 2020 from COVID. They brought it back, and now it's around 0.2, 0.3%. And the forecast is for the yield to be 0.2% by 2026. In the past year, there's been some insider selling, some buying, but the sells were really small, 1,700 and 4,400 shares. The buys were much bigger, 18,000, 1,800, and 1,800. Almost the entire company is held by institutions. The biggest shareholder is Zena Investment, 11.5%, then Vanguard, BlackRock, and Fidelity. They had 20,000 employees in 2013. It peaked in 2020 at 31,000. It's currently at 25,000. The company trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Mexican Bolsa, and Sao Paulo Bolsa. Let's look at the stock on Yahoo Finance. It's trading at $84, 5.3 billion market cap. The 52-week range is 43 to 95. Beta of 2.11, so it's really volatile. PE of 26, EPS of 324. And their 1-year price target is $96. It looks like the stock started trading in 1980. It went up a bunch the first couple of years, so they did a 2-for-1 stock split. Then in 87, they did a 5-for-2 stock split. and the stock got way up there to close to $40. That was in 1994. From 94 to 2004, the stock went down, but it never really went up. So there wasn't any appreciation for those 10 years. But you did get your dividend payment. It broke through $60 in 2007, then the Great Recession hit. It fell to about 13, 14 at its lowest. Then over the next decade, it ran up a lot, past 150, close to 160. It did drop to below 50 during COVID, then went up to over $100, close to 125, fell to below 50 again. Now it's trading in the 80s. That's why it's so volatile. It has a beta above 2. Their market cap in April 2022 was $4.9 billion. It dropped to $3.3 billion in October 2022, but it is back up to $5.3 billion. So this stock is up the past year. The prior stocks in this video were down a lot this year. It's up 39% in the past 52 weeks, while the S&P is up 17%. Over 1 million shares are traded each day. Pretty much all the shares outstanding are on float, and about 6% of the shares on float are shorted. Here's their most recent 10Q as of 4/30/2023. This is their income statement, the 3 months ending 4/30/2023 compared to the 3 months ending 5/1/2022. Revenue is up a little, about $2.1 billion. Here's a breakdown of the $2.1 billion. Tommy Hilfiger North America, $290 million. Tommy Hilfiger International, $830 million. Calvin Klein North America, $270 million. Calvin Klein International, $600 million. Heritage Wholesale, $145 million. So that makes up all their revenue. They do get a little revenue from royalties and a little from advertising. So the total is $2.2 billion. Cost of goods sold, $900 million. Gross profit, $1.25 billion, similar to last year. SG&A, selling, general, and administrative expenses, like payroll for certain functions and marketing, $1 billion. Operating income, $200 million. Interest expense, $25 million. Net income, $136 million, up a little from last year. So their EPS is $2.17, up from $1.96. The reason their EPS is so much higher than last year is because they bought back a lot of stock. Last year they had 68 million shares outstanding. Now they have 62.7. The fifth company we're going to look at is Columbia Sportswear. Let's get started with the model. This is a mid-cap company, $4.8 billion market cap. They're trading at $77 a share, and they have 62 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a decent amount of free cash flow in 2020 and 2021, peaking at $320 million. It went negative in 2022. Looks like they're investing a lot back into CapEx. Then a small positive in the trailing 12 months, positive $27 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. 2020 was low due to low revenue from COVID. It came back up to $350 million in 2021. Then it's around $300 million after that. Revenue is a sales for the company, and that went from $2.5 billion to $3.1 billion. It jumped up to $3.5 billion, increased a little bit in the trailing 12 months to a little over $3.5 billion. Let's look at the capital structure. $2 billion of equity, $400 million of debt. They're 84% equity, 16% debt. Their net debt is negative $88 million, so they have about $450 million of cash on their balance sheet. So that means they could pay off all the debt with the cash on their balance sheet if they wanted to. Their WACC is 10.3%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's $6.1 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.2 billion. We divide that by 62 million shares. And we get a calculated stock price of $84. They're trading at $77, so they're trading at an 8% discount. It's a buy according to the model. They pay a quarterly dividend that they raise each year. It was 19 cents in 2017, up to 22 cents, 24, 26, 30, and they kept it at 30 from last year. That's a yield of 1.5%, which is nearly 3 times their free cash flow, but only 26% of their net income. Let's look at Columbia Sportswear on Simply Wall Street. Last price was $76.92, market cap $4.8 billion, up 1% in the past 7 days, up 8% in the past year. Columbia Sportswear designs, sources, markets, and distributes outdoor, active, and everyday lifestyle apparel, footwear, accessories, and equipment in the US, Latin America, the Asia Pacific region, Europe, Middle East, Africa, and Canada. Simply Wall Street values the company at 108. They say the stock is 29% undervalued. 11 analysts priced this stock and the average price target is 97. They say the stock is 26% undervalued. In mid-2012, their revenue in the trailing 12 months was $1.7 billion. And then it grew nicely each year, hitting $3 billion in December 2019. It did drop to $2.5 billion because of COVID, but post-COVID it's done great. They're at $3.5 billion, their highest ever. Their dividend yield in 2012 was 1.7%. It dropped below 1% in 2015. Then right before COVID, it was 1.5%. They did cut their dividend in 2020 from lower sales from COVID. They did bring it back. It was 1% in the beginning of 2021, 1.5% recently. The forecast is for the yield to be 1.7% by 2025. There's been only one insider trade in the past year, a buy for 500 shares. Half the company is held by institutions, 43% by insiders, and 8% by the general public. The CEO of the company, Timothy Boyle, is the biggest shareholder at 38%. His value of the company is $1.8 billion. Must be nice to be a billionaire. The next biggest is Eaton Vance, BlackRock, Vanguard. The CEO's son, Joseph Boyle, owns 4.4% of the company. They did have 4,200 employees in 2012, and that's more than double to 9,500 currently. The stock trades on the Nasdaq, Deutsche Börse, and Sao Paulo Bolsa. Let's look at the stock on Yahoo Finance. It's trading at $77, 4.8 billion market cap. The 52-week range is 65 to 98. A beta a little below 1, 16.5 PE, 466 EPS. And the 1-year price target is $97. It looks like the stock started trading in 1998, and it did really well the first couple of years. So they did a 3-for-2 stock split, and the stock price kept running up to over $100 in 2019. And then when COVID hit, it fell to 70, and then over the next few months, it got to its highest point ever. It's down about 25-30% from the peak. Their market cap last year was higher at $5.7 billion. It fell to $4.2 billion. At the end of the first quarter of this year, it was up to $5.6 billion, but it took a big dip down to $4.8 billion. The stock is up 7% in the past 52 weeks, while the S&P is up 17%. About 350,000 shares are traded each day. Of the 62 million shares outstanding, 36 million are on float. Half the shares are held by institutions, and about 3% of shares are shorted. Here's their most recent 10Q as of 3/31. Here's their first quarter income statement compared to the first quarter of last year. Revenue of $820 million, up about 9% from last year of $760 million. Let's get a breakdown of the $820 million. Of the $820 million, $630 million is from apparel, accessories, and equipment, $188 million from footwear. Of the $820 million, $450 million is wholesale, $368 million direct to customer. Here's a breakdown of their revenue by location. The United States, $517 million. Latin America, Asia Pacific, $136 million. Europe, Middle East, and Africa, $108 million. And the great country of Canada, $58 million. The cost of revenue, the cost to make the products, the payroll, things like that, $421 million. A gross profit of $400 million. That's about a 48-47% margin because it's a little less than half their revenue. Selling, general, and administrative expenses, $347 million. Operating income, $56 million. That is down a lot from last year of $83 million. Their SG&A is up a lot. It was $300 million, now it's $350 million. So it went up quite a bit, a lot more than their revenue went up. Here's a breakdown of the income statement by percent of revenue. So SG&A is 42% of their revenue. The way you calculate that, it's $347 million over $820 million. That's 42%. Last year, it's 39%. So you can see it went up a lot more than its revenue. That's why their operating income is only 7% of their revenue. Last year was 11%, so their margins are getting squeezed. You can just search the term SG&A to figure out why it went up so much. Here's a nice little chart. SG&A, 42% of its revenue. Last year, 39%. It went up 300 basis points, or 3%. SG&A growth reflects elevated expenses to support the growth of our business, inflationary pressures, which I think is the main reason it went up so much, and investments to drive our brand-led consumer-focused strategies. SG&A expenses increased primarily due to the following factors. Higher supply chain expenses of $18.8 million, reflecting increased global distribution center expenses, including higher warehousing and fulfillment expenses, resulting from elevated inventory levels, as well as third-party logistics transition-related costs. Higher omni-channel expenses of $13.8 million, including higher direct-to-customer expenses, including variable expenses, including personnel expenses and costs associated with new stores. So their net income is $46 million, last year $67 million. EPS is down from 104 to 74 cents. They are buying back stock. Last year they had 64 million shares outstanding. Now they have 62 million. The sixth and last company in this video is Under Armour. Let's get started with the model. This is a mid-cap company, 3.3 billion market cap. They're trading at $8 a share, and they have 421 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow in 2020 was $363 million. It was low in 2021 due to COVID. 2022, it got right back up to $600 million, but negative in 2023. It looks like they're putting a lot back into CapEx. Net income is the profit or loss on the income statement. It's revenue minus expenses. A small positive in 2020, a big negative in 2021, then back to positive in 2022 and 2023. They just completed their 2023 fiscal year. Their 2023 fiscal year started April 1st, 2022 and ended 3/31/2023. Revenue is a sales for the company, and that went from $5.3 billion to $4.5 billion, then back up to $5.7 billion, then even higher to $5.9 billion in 2023. Let's look at the capital structure. $2 billion of equity, $1.5 billion of debt. They're 57% equity, 43% debt. Their net debt is $800 million, so they have $700 million of cash on their balance sheet. I gave them a WACC of 10.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $6.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.5 billion. We divide that by 421 million shares. And we get a calculated stock price of $13. They're trading at $8, so they're trading at a 39% discount. It's a strong buy according to the model. Let's look at the stock on Simply Wall Street. Last price $783, market cap $3.3 billion, up 3% in the past 7 days, down 15% in the past year. Under Armour develops, markets, and distributes performance apparel, footwear, and accessories for men, women, and children. Simply Wall Street values them at $574. They say the stock is 36% overvalued. 22 analysts price this stock, and the average price target is $10.61. They say the stock is 36% undervalued. Their trailing 12-month revenue in 2012 was $1.6 billion. And then it tripled, went up 200% by 2017 to $4.9 billion. It dropped a little bit in 2020, but came right back up. It's almost at $6 billion. 67% of the company is held by institutions, 20% by the general public, and 13% by insiders. The founder of the company, Kevin Plank, owns the most stock, 11.6%. His value is $400 million. The next biggest is Vanguard, BlackRock, State Street, and Millennium. They only had 3,900 employees in 2012, and that grew a lot over the years. It peaked at 11,700 in 2019. They're currently at 11,100. The stock trades on the New York Stock Exchange, Deutsche Börse, Xetra, Mexican Bolsa, the London Stock Exchange, Wiener Börse, EuroTLX, and the Sao Paulo Bolsa. Here's a stock on Yahoo Finance. It's trading at $783, 3.3 billion market cap. The 52-week range is 638 to 13. Beta of 1.6, PE of 9, really good PE, EPS of 84 cents, and the target price is $10.50. So they're saying it's pretty undervalued. It looks like the stock IPO'd in 2005, and then it blew up in 2011 up to 2015, breaking through $50, its highest ever by far. And they did 3 2-for-1 stock splits since the stock price got so high. One in 2012, one in 2014, and one in 2016. If they didn't do any of these stock splits, the stock would have peaked at $400. But as you can see, the stock has really suffered the past few years. It's down about 90% from the peak, trading below $8. If you bought the stock in mid-2007, you'd be flat right now. Last year, their market cap was $7.5 billion. Its lowest point was $2.9 billion in September 2022. It's at $3.3 billion. So the stock is down 12% in the past 52 weeks, while the S&P is up 17% in the same time frame. About 7 million shares are traded each day, and almost 8% of the shares on float are shorted. I couldn't find their 10K, but this is their press release for their 2023 financial results. The outlook for 2024 is revenue is expected to be flat or up slightly. Gross margin up 25 to 75 basis points. CapEx expected to be $250 to $270 million. Revenue in 2023 fiscal year $5.9 billion, up from $5.7 billion. COGS $3.3 billion, which is up quite a bit from $2.9 billion. Their COGS as a percent of revenue is 55%, up from 50%. So lower gross profit. Gross profit of $2.6 billion. Gross margins 45%, down from 50%. SG&A is down under $2.4 billion. Last year it was over $2.4 billion. Operating income $280 million, 5% operating margin compared to 5.8% last year. Net income $386 million, which is up from $222 million. The reason their net income is higher was this $100 million tax benefit. Last year they had to pay $30 million in taxes, so that's a $130 million swing. It was mainly from this most recent quarter, the 3 months ending 3/31/2023, that a tax benefit of $148 million. Here's a breakdown of the $5.9 billion of revenue. $3.9 billion from apparel, $1.5 billion footwear, $400 million accessories. $3.5 billion of their revenue is wholesale, $2.3 billion direct to customer. Of the $5.9 billion of revenue, $3.8 billion North America, $1 billion EMEA, $800 million Asia Pacific, $200 million Latin America. Let's close out the video by looking at all the stocks in this industry. There are 21 tickers in the industry apparel manufacturing. And the companies we looked at today were Ralph Lauren, VF Corp, Levi Strauss, PVH, Columbia Sportswear, and Under Armour. If you see a number in red, that means it's worse than the industry median. A number in blue, that means it's better. All 6 companies spend more on CapEx than the median. Columbia spends the least at $60 million. Levi Strauss the most at $300 million. Ralph Lauren, VF Corp, and Levi Strauss are more leveraged than PVH, Columbia, and Under Armour. That's one way to scale and grow, is lever up, take on debt. VF Corp is the most leveraged. For every dollar of equity, they have $2.70 of debt. Columbia is the least leveraged. For every dollar of equity, they have 20 cents of debt. 5 of the 6 companies pay a dividend. The average in the industry is 2.2%. The median is 2.4%. VF pays the most of the 6 companies we looked at, but Hanes pays the most on this list, almost 10%. Ralph Lauren and Columbia generate positive free cash flow, the others negative. Ralph Lauren is the largest company on the list at $8 billion, then VF at $7.6 billion, Levi Strauss at $6 billion, PVH $5.3 billion, Columbia Sportswear $4.8 billion, and Under Armour $3.3 billion. The top 3 companies have a price to book worse than the median. The bottom 3 have a price to book better than the median. Price to book is stock price over book value per share. PE is stock price over earnings per share, or market cap over annual earnings. Ralph Lauren, Levi Strauss, and Under Armour are better than the median. Under Armour is really good, 8.5. But VF, PVH, and Columbia are worse than the median. All the companies have a pretty weak price to free cash flow. Ralph Lauren is a little better than the average, but worse than the median. 4 companies have negative free cash flow, so we can't even calculate this figure. And Columbia has a really small amount of free cash flow. Their price to free cash flow is above 100. I capped the numbers at 100. VF Corp, Columbia, and Under Armour have a price to sales below 1. Since it's below 1, that means their revenue is higher than their market cap, because price to sales is revenue over market cap, or stock price over revenue per share. Columbia is the worst at 1.4. All the companies generate more revenue than the average and median. VF Corp generates the most, Columbia the least. In terms of 5-year annual revenue growth rate, VF Corp is 8%, Columbia 7%, and PVH is slightly below 0%. So let me know what you think of the video. Leave a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.